Today, we're diving into something really fascinating that's happening in the market right now, a massive, dramatic split. Forget that old saying about a rising tide lifting all boats. That's just not what's happening. Instead, we're seeing this incredible divergence where industrial sectors are basically hitting escape velocity, while consumer-focused sectors are just falling off a cliff. So let's get right into it and decode what's going on.
So, to really wrap your head around this, think of all the money in the market like one giant river. For a long time, that river has flowed in one general direction. But what we're seeing now, as this image shows, is that the river's forking. A huge amount of capital is being rerouted, flowing out of those traditional, safer consumer areas, and it's flooding into the industrial side of the economy. And we're not talking about a small shift here. This is a major, aggressive rotation of capital. And this quote just hits the nail on the head. The market is not a monolith anymore. The days where everything just kind of goes up or down together, well, they're on pause, for now. What's happening instead is that the big money, the institutional players, are making some very deliberate, very aggressive choices. They're pulling out of sectors that get hurt by high interest rates and piling into what we call industrial value cyclicals. These are the companies that make and move physical stuff, the ones that really hum when the economy is strong. This rotation is the engine driving this whole story.
Okay, so let's get right to the evidence, because seeing is believing. And honestly, nothing shows this split more clearly than when you put the biggest winner right next to one of the biggest losers. The difference is, well, it's just stunning.
And here it is, the tale of two markets in one picture. On the left, you've got the CNX metal index just going parabolic. I mean, look at that move, it's almost straight up. And then on the right, you have the CNX FMCG index, that's your everyday consumer goods, and it is in a state of complete capitulation. It's just a waterfall decline. The connection between these two has totally shattered. They are living in completely different universes right now.
So let's break down the why behind those charts. We can use a really simple health indicator, the 50-day moving average. Think of it as a baseline. Well, the metal index is trading way, way above that baseline, which is a sign of just incredible strength. Meanwhile, the FMCG index has completely collapsed below it, signaling what traders call a liquidation event. It basically means people are selling at any price just to get out. The big takeaway here? That traditional safe haven trade where you buy consumer stocks when you're nervous, it has totally failed. Okay, so let's pop the hood on the winner's circle. Let's take a closer look at the sectors where all this money is finding a new home, the places with all the power and momentum right now. And here are two of the absolute powerhouses. We've already seen metals, and you can see that trend is just getting stronger and stronger. That's pure impulsive buying. Right next to it, you've got public sector enterprises, or PSEs. These are basically state-owned companies, and they are in a massive parabolic recovery. And you see that golden cross on the chart? That's a classic technical signal that tells you some very, very strong upward momentum is underway. And another leader in this pack is the PSU Bank Index, so state-owned banks. What I really want you to notice here is just how clean that uptrend is. See how the price is just smoothly riding that short-term average upwards? This isn't some chaotic, speculative frenzy. Our chart that looks like this just screams one thing: sustained buying by the big institutions. They have very high conviction here, and they're not hiding it. All right, but for every boom, there's often a bust somewhere else. So let's flip the coin over and look at the other side of this story. Let's see exactly where all that money is being pulled from to fuel this industrial fire. And wow, it is a pretty bleak picture. On the left, you've got the realty sector, which is in what the analysis calls a catastrophic breakdown. This isn't a dip, folks. It's a crash. On the right, we've already seen the FMCG sector, which is just in this slow, grinding, relentless fade. Now, both of these are super sensitive to interest rates, and this kind of weakness suggests the market is really worried that high borrowing costs are starting to bite the consumer hard. The warning here is crystal clear. Do not try to catch these falling knives. And the bad news for the consumer story just keeps coming when we look at the auto sector. See that peak on the chart? The price ran up to a previous high and was just rejected. It's a classic sign of failure. And then, to make matters worse, that fast-moving average crossed below the slow one, which is basically a confirmation that a new bearish trend has begun. The verdict here is simple. The auto sector joins the sell or avoid list. Okay, so it's not all black and white, right? Not every single sector is flying high or crashing and burning. Some are kind of stuck in the middle, caught in what you might call a technical battleground. It's basically a tug of war between the buyers and the sellers, and nobody's winning just yet.
And this is a great comparison of that middle ground. You've got the IT sector on one side, it's been really volatile, whipping up and down, but, and this is the important part, it is holding above that critical 50-day average. It's hanging on. But then you look at infrastructure and it's already slipped below its baseline, which is a sign of weakness. And even more worrying is that potential head and shoulders pattern that's forming. That is a classic textbook warning sign of a major trend reversal to the downside. So what about the other usual hiding spots, like pharma or multinational corporations? Well, they're just being completely ignored. Look at these charts. They're just flatlining, grinding sideways, doing absolutely nothing. In a market where some stocks are going parabolic, having your capital sit here is what we call dead money. It just shows you how laser-focused this rotation is. Capital isn't looking for safety, it's looking for industrial strength. So if we boil all of that down, this scorecard is basically the executive summary. In Tier 1, you have your leaders, Metal, PSC, PSU Bank. They are strong, they are flying high. Down in Tier 3, you have the Laggards, Realty, FMCG, and Auto, which are in clear downtrends or worse. And then, stuck in the middle is Tier 2, the Battleground, with sectors like IT just trying to hold on. This gives you a really clear health matrix of the entire market in one glance. Okay, so that's the what. Now for the most important part, the so what. What do you actually do with all this information? How can you possibly navigate a market that's this divided? Let's get into the strategic playbook.
The game plan here really comes down to 3 key steps. Step 1, risk management. If you have any holdings in those weak consumer sectors, you need to tighten up your stop losses. The technical damage is real, and this is not the time to try and be a hero by bottom fishing. Step 2 is capital allocation. The smart move seems to be rotating that capital into the industrial leaders. But, and this is crucial, do it smartly. Wait for a pullback, don't chase stocks that are going straight up. And finally, step 3 is your watch list. Keep a very close eye on the IT sector. If it can hold that key support level, it could be the next group to take leadership. And, if you remember just one thing from all of this, let it be this. In a market that's split like this one, your number one, your primary risk management tool is simply being on the right side of the trend. Trying to fight this massive flow of capital that we've just seen is probably a losing game. Aligning with it is everything.
So I'll just leave you with this one final thought to reflect on. Given everything we've seen, this great divergence between industrial strength and consumer weakness, take an honest look at your own portfolio, at your own strategy, and ask yourself, are you aligned with the powerful currents of the market, or are you fighting the flow of capital?